Very good day, my dear students. In this video, I am going to explain to you how to compute total income and tax liability, where you have the default tax regime applicable, as well as the optional tax regime applicable, as well as there is an angle of alternate minimum tax or AMT. If you recollect, in the last video, I had explained to you the right approach or the correct approach which you should follow in solving questions which ask you to compute tax liability of the assessee. And I shared with you various examples as far as the language of the question is concerned. And I told you that it's very important for you to very carefully, with concentration and with full attention, patiently read each and every word carefully of the question if you want to understand what exactly the question is asking from you. And I told you that several times students make these mistakes, they get confused, they are not able to figure out what exactly needs to be done. There is omission on their part, careless mistake. Because of these silly errors of not able to properly understand what the question is actually asking, they make mistakes. So in the last video, I shared with you several examples of what the question could look like, how the question could read, and I told you what is the approach that you should consider in computing the total income and tax liability, and what are the things that you should not consider, or what are the things that you should ignore. And in that video, I had also shared with you a quick recap of certain points, which at the cost of repetition, I'll state in this video as well. So when we are talking about computation of tax liability, you can compute tax liability either under the default tax regime, which means under section 115 BAC, right? Or under the optional tax regime. So if the assessee opts out or moves out of the default tax regime, what becomes applicable is the optional tax regime. And when we are talking about the optional tax regime, the provisions of alternate minimum tax or AMT can also come into play. What you need to note is when 115 BAC is applicable, AMT is not applicable. So either you compute the total income and tax liability under section 115 BAC default tax regime. If not, then you compute under the optional tax regime, and when you are computing under the optional tax regime, you also apply the provisions of AMT if the conditions of application of those provisions are satisfied. So accordingly, what I told you in this last video is basically the approach that you should follow while computing the total income and the tax liability. And in this video, I want to specifically focus on serial numbers 5 and 6. Serial numbers 5 and 6. In serial number 5 or 6, the question will state, so there will be this fact pattern, all the various points, and then at the end the question will ask you to compute tax liability in the manner most beneficial to the assessee, or the question may simply ask you to compute tax liability of the assessee. The interpretation of both these wordings is the same. The approach remains the same, because whether or not the question specifically asks you to compute the tax liability in the manner most beneficial to the assessee, this is understood, this is implied, this is implicit. So even if the question is silent on this, it still means that you are supposed to compute tax liability in the manner most beneficial to the assessee. Now, in such cases, the question will not refer to, or the question will not ask you to make computation under a specific tax regime, default or optional tax regime. It will not mention anything about AMT. So what you will need to do is you will need to compute the total income and the tax liability both under the default tax regime and the optional tax regime. Okay. When you are computing under the default tax regime, obviously you know that AMT provisions will not apply. When you are making computation under the optional tax regime, you will have to go through the question and figure out whether, based on the fact pattern of the question, AMT provisions are applicable or not. And if they are applicable, you will have to consider AMT provisions as well, right? And then you will have to compare the results under the default and optional tax regime, and then arrive at the position which is most beneficial to the assessee, and that will be your answer. And in support of your answer, you will need to give a short note as well. that the tax liability under the default tax regime is this, while the tax liability under the optional tax regime within bracket read with AMT provisions, or if AMT provisions are not applicable, this is not to be mentioned. So you will need to mention that tax liability under the default tax regime is this, under the optional tax regime is this. Since tax liability under this tax regime is lower, it will be more beneficial to the assessee to make computation under this particular tax regime. So accordingly, you will have to give a note and then write the answer in that particular way. So what we will do in this video is we will look at how to make computation when the question is worded like this, as in serial number 5 and 6 here. When the default tax regime is also to be considered, optional tax regime is also to be considered, and AMT provisions are also to be considered. The reason why I'm making this video is many students have a lack of conceptual clarity. They make a lot of mistakes. ICI examiners have also pointed out towards these mistakes in the past. Such type of questions have been asked in the past, and they will likely be asked in the future. So it's very important that you understand the correct method or the correct approach of solving such type of questions where you have all these multiple provisions and angles which are involved. So we will break this video into a recap, a very quick recap of the key provisions of AMT as well as 115 BSE default tax regime. And then we will move to solve a question which will give you a solid grounding of the concept. So let's begin with a quick recap of the provisions. So AMT, alternate minimum tax, section 115 JC to 115 JF, applicability of AMT. The provisions of AMT apply to a person other than a company. So it applies to individual, HUF, firm, AOP, LLP, etc., but not to a company. And for application of AMT provisions, all the following conditions should be satisfied, and there are 3 conditions basically. Condition number 1 is the person has claimed any deduction under the following provisions. So the sections are 80 JJAA, 80 QQB, 80 RRB, 10 AA, and 35 AD. So 80 JJAA, 80 QQB, and 80 RRB are the provisions relating to deductions from the gross total income under Chapter VIA, and 10 AA and 35 AD are part of the business income computation provisions. So if in the question you find that any one or more of these sections, the deductions has been claimed under this section, that means condition number 1 is satisfied. Okay. The moment you see, you should then decide to apply AMT provisions, and consequently you should then figure out the adjusted total income. You should compute the adjusted total income and see whether it is more than rupees 20 lakh or not. Okay, and this is condition number 2. And third thing that you should check is that the tax payable on total income is not computed as per the default tax regime under section 115 BSC, which means that if default tax regime is being applied, AMT provisions are not applicable. If default tax regime is not being applied, that means if it is a case of computation under the optional tax regime, then you also need to apply AMT provisions. If default tax regime is being applied, then you need not apply AMT provisions in that case. Okay. So these 3 conditions should be satisfied. What is the adjusted total income? This is to be computed in this particular manner, and there are basically 3 steps which are involved. So you start with the total income. Under which tax regime? Under the optional tax regime, because AMT is not applicable in the default tax regime. So we are now talking about optional tax regime. So you compute total income, and then you start with the total income and you add certain deductions And these are deductions under section 80 JJAA, QQB, RRB, 10AA, 35AD, basically those sections which are specified under AMT. So these deductions are not supposed to be claimed, and therefore you need to add them back, because the assessee would have claimed these deductions while computing total income under the optional tax regime. So you need to add them back. And now what you need to note is, if there is a deduction under section 35AD and you are adding 35AD back, that means you are not allowing 35AD deduction to the assessee. Okay. Now, if 35AD deduction is not allowed, then at least the depreciation on the assets in respect of this 35AD deduction was being allowed, should now be allowed. Okay. So in lieu of 35AD deduction rollback, what you will allow is the depreciation. So you will reduce less. In case deduction is claimed under section 35AD, what you will now allow is the depreciation under section 32, as if no deduction under 35AD was allowed. Okay. So in respect of the assets on which 35AD is claimed. So if you are not allowing 35AD, then in respect of those assets which were covered under 35AD, you should allow depreciation and accordingly reduce. And this will give you the amount of adjusted total income, and you will need to check whether the adjusted total income or ATI is more than rupees 20 lakh. So if deduction under any of these section is claimed, ATI is more than 20 lakh and 115 BAC is not applicable, then AMT becomes applicable. And then you need to make computation of AMT, alternate minimum tax. And then what you need to do in step 1, you need to compute the regular tax payable for the previous year. Tax on total income plus applicable surcharge and HEC at 4%. So you need to compute regular tax. Regular tax means the regular tax on the total income that you computed under the optional tax regime. That is the regular tax. On the other hand, you need to compute AMT payable on what? On the adjusted total income. So regular tax on the total income and AMT on the adjusted total income. And the rate of AMT will be 18.5% flat of ATI plus surcharge and HEC. HEC 4%. Surcharge is applicable. Okay, and then you will need to compare regular tax and AMT. Now, if regular tax is less than AMT, then AMT becomes payable. Why? Because AMT means alternate minimum tax. So it is the minimum amount of tax which the government wants you to pay. So if the regular tax is less than AMT, the government wants you to pay at least the AMT. So AMT becomes payable. So what you need to check, if regular tax is less than AMT, then ATI is deemed to be the total income. It becomes the total income, and the person is liable to pay AMT on such ATI, which is now the total income at the rate of flat 18.5% plus surcharge and HEC. Okay. In case of cooperative society, the rate of AMT is 15% instead of 18.5%. Now, since the AMT that you pay is obviously more than the regular tax, there is a difference. Okay, that excess, there is an excess. So you can claim the credit of that excess. Okay, so this is called as the AMT credit, and this is AMT paid minus regular tax payable. So that excess which you paid over the regular tax in the form of AMT, that is the AMT credit which can be carried forward, okay, for 15 assessment years, and it can be set off. It can be set off in a particular year. In which year? It can be set off in the year in which regular tax is more than AMT. So when the regular tax is more than AMT, obviously you won't pay AMT, you will pay the regular tax. Okay, and the amount by which regular tax is more than the AMT. Okay, to that extent you can set off the AMT credit which you have brought forward from the year when you paid AMT. When you paid AMT, you got the AMT credit which you carry forward, and you set it off in which year? In which you don't pay AMT, you pay regular tax, because the regular tax is more than AMT. So the excess, regular tax more than AMT, the excess, to that excess you set off, with the result that your regular tax comes down to the extent of that set off. If there is a balance, you continue to carry it forward. The limit is 15 assessment years. So this is a quick recap of AMT, and now we move to concessional rates of tax under section 115 BAC. This is the default tax regime, and it applies to individuals, HUF, AOP, BOI, AJP. And in this case, we are aware that certain concessional rates of tax apply. We are not discussing the rates of tax, and the assessee is required to forego certain exemptions and deductions. So basically the total income. So when you are making computation under the default tax regime, the total income should be computed without allowing the exemptions or deductions under the provisions which are listed in this table. And in this table you can see all these exemptions, deductions are blocked under the default tax regime. That means you must not allow, and I have arranged them as per the heads of income. So income from salaries, various items, and income from house property, PGBP, IFOS, clubbing of income, and then deduction from gross total income, which are blocked. Now, what I want you to note here is in AMT, what were the specified sections which you were supposed to add back? As far as PGBP was concerned, 10AA and 35AD. As far as deductions from gross total income was concerned, three sections: 80JJAA, 80QQB, and 80RRB. Right? 10AA is special economic zone, 35AD tax incentive or deduction in respect of specified businesses, 80JJAA deduction on account of employment of new workmen, new employees, 80QQB and 80RRB deduction related to royalty on books and royalty on patents, right? So I'm not going to go into details of these sections, but what I want you to note here is when you talk about PGBP, so 10AA and 35AD, if the assessee has claimed 10AA or 35AD, then AMT provisions you need to consider, and you need to add back 10AA and 35AD deduction. Here also, when you are computing the total income under default tax regime, the same 10AA and 35AD deduction you need to add back because these are blocked. So same for AMT, you need to add back. For default tax regime under 15 BSE, you need to add back because these are blocked. What about deductions from GTI? 80JJAA, 80QQB, 80RRB. Now 80QQB, 80RRB, you had to add back. You had to add back because these are not allowed under AMT. So you add back in AMT. Similar is the position. They are blocked. 80 QQB and 80 RRB are blocked. So under default tax regime also you need to add them back. But the difference is on account of 80 JJAA. 80 JJAA you need to add back while computing AMT, adjusted total income. Okay. But when we are talking about default tax regime, 80 JJAA is not blocked. It is allowed as a deduction. Okay, this is what many students make a mistake. They they don't allow 80 JJAA in default tax regime, and they add back for computing AMT as well. This is wrong. You should add back while computing AMT, but you should not add back because while computing total income under default tax regime, because 80 JJAA is not blocked under default tax regime. Okay, the other thing which I would like to mention here is opting out of default tax regime. So if the person opts out of default tax regime and there are certain conditions, if those conditions are satisfied, the opting out can happen. In that case, optional tax regime becomes applicable. In case of a person having income from business or profession, PGBP income, there is a restrictive condition in respect of opting out. So if you find that in the question there is PGBP income, and if you find ultimately that the provisions of optional tax regime are more beneficial to the assessee, you would like to mention that the assessee should opt out of the default tax regime because the tax liability under the optional tax regime is lower. But in such case where there is PGBP income, you must also write that the assessee should in such case note the restrictive condition that the option to opt out once exercised for any assessment year can be withdrawn only once for a previous year other than the year in which it was exercised. Thereafter, the person shall never be eligible to exercise the option except where such person ceases to have PGBP income. So this is the restrictive conditions, and I'm sure most of you are aware of this, but this is a note which you should give in the answer, that your answer of opting for the optional tax regime is subject to this restrictive condition which the assessee should make note of. Okay, now having done a quick recap, we will now solve a question which will give you a good idea as to how to approach such kind of questions if you encounter them in your exams. So AMT as well as default tax regime, both are applicable in this question. So let's look at the question and then let's solve the question. Compute the total income and tax liability of Mr. J, a resident of age 40 years, from the following particulars for AY 24-25 in the manner most beneficial to him. In the manner most beneficial to him. This is all that is mentioned in the question as far as what you need to do. So as you see, this is the same as number 5. Compute tax liability in the manner most beneficial to the assessee. Okay. So we will need to apply default tax regime, optional tax regime, and also look at AMT. All these 3 angles we will need to incorporate. So what are the facts? Manufacturing unit set up in SEZ during FY 2019-20. The moment you look at SEZ, you must realize that it has got something to do with deduction under section 10AA. Profits of the business of unit, export turnover of the unit, domestic turnover of the unit. These 3 metrics are given. Then you have business of cold chain facility started on 1st April 2023. Now, the moment you look at cold chain facility, you should be able to figure out that 35 AD deduction is available. Profits from operation before deduction under 35 AD, cost of building capitalized in books as on 1st April 2023, cost of land which is capitalized in books as on this date, and then deduction allowable under 80JJAA. Okay, so now you know that 10AA is getting applicable because of SEZ, because of cold chain facility. 35 AD is getting applicable, and 80JJA is specifically given in the question. And now you know that these are the sections which have been specified in AMT. Therefore, you need to explore AMT provisions as well. And since the question has asked you to compute the total income and tax liability in the manner most beneficial to him, that means default tax regime and optional tax regime both need to be applied and considered before arriving at the final answer. Both businesses satisfy the conditions for availing deduction under section 10AA and 35 AD. So all conditions are satisfied, and now we look at how to solve the question. So first we will make the computation under the default tax regime, and then we will make the computation under the optional tax regime. When we are making computation under the optional tax regime, within that computation we will make 2 computations. One as per the regular provisions and one as per the AMT provisions. So this is how you should approach. First, you make computation as per the default tax regime. Then you make computation as per the optional tax regime. Within optional tax regime, you make 2 computations, one as per the regular provisions and second as per the AMT provisions if AMT is applicable. So we first make computation as per the default tax regime, and PGBP, gross total income, and then total income. So there is no other head except for PGBP. So we write profits and gains from business or profession, and then profits of the business of unit is 30 lakh rupees. So we write profits of business of unit is 30 lakh rupees. Then we write profits from operations from cold chain facility before 35 AD deduction is 1 crore. So we write 1 crore here, less deduction under section 35 AD. But 35 AD is blocked under the default tax regime. So we write blocked under default tax regime, and then we don't give any deduction. The balance is 1 crore rupees. Acha, for profits of business of SEZ unit, we know that 10AA deduction should have been mentioned here. But 2 points here. 10AA deduction is given at the level when we have computed the total income. That means later, at a later point of time, not while computing PGBP, right? And second point is we are talking about default tax regime, so 10AA deduction is anyways not available. But the right method of writing is that profits of business of SEZ unit, we don't mention 10AA deduction here, we will mention it later. Then we mention profits from operation of cold chain facility, and then less deduction under 35 AD, but then it is blocked. So we write dash and then 1 crore. Now, When we are talking about default tax regime and when we are blocking deduction under 3580, the same logic applies as we noted in the case of computation of adjusted total income, that if you are blocking 3580 deduction, in lieu of that you should allow depreciation, which would have been allowed if 3580 was not allowed. Okay. So cost of building is given and cost of land is given. And you know depreciation is allowable on building, it is not allowable on land. And the rate on building is 10%. So all this may not be given in the question, so you will need to figure out. So then you write less depreciation on building at the rate of 10%. Normal depreciation is allowed under default tax regime. Under default tax regime, normal depreciation is allowed, additional depreciation is not allowed, right? So normal depreciation at the rate of 10%. Cost of building is what? 70 lakh rupees, so 10% is 7 lakh. This is what you reduce. So gross total income is the total of this, which comes to 1 crore 23 lakh. From the gross total income, what you do is you have a deduction under section 80JJAA, which you can see. Now 80JJAA is not blocked under the default tax regime, so less deduction allowable under 80JJAA, not blocked, 5 lakh rupees, because this is 5 lakh rupees. And at this, so total income before deduction under section 10AA. So, and at this point, you are supposed to allow deduction under 10AA, but it is blocked under the default tax regime, so nothing. So basically total income comes to 1 crore 18 lakh rupees. And now you compute tax on total income of 1 crore 18 lakh at the rates applicable to default tax regime, which comes to 32 lakh 40,000. And then you add surcharge because the total income is more than 50 lakh rupees. And the rate of surcharge is 15%. Why? Because the total income is more than 1 crore and up to 2 crore. It's 1 crore 18 lakh. So 15% of 3240 comes to 4 lakh 86,000. This is the balance on which you apply 4% cess, and this is the tax liability under the default tax regime 38,75,040. So this is how you make computation under the default tax regime, and the amount that you get is 38,75,040. Okay. So 3580 is blocked, you don't allow, but in lieu of that, you allow depreciation. And if there is 10AA, 10AA is also something that you do not allow, but 80JJAA, if you find, you allow that deduction because it is not blocked. You need to remember all these points. And then you need to add surcharge, cess, and this gives you the tax liability. This is step 1. In step 2, we now move to compute the total income and tax liability as per the optional tax regime. And as I told you before, you need to do this in 2 parts. One is you may need to make the computation as per the regular provisions, and then you need to make the computation under AMT provisions. Okay. Why AMT provisions? Because 10AA, 3580, 80JJAA, you see all these sections here. So immediately you should realize that you should need to figure out whether AMT provisions are applicable or not. So computation of tax liability as per regular provisions under the optional tax regime. Okay. Now we compute profits in case of business of profession. Profits of business of SEZ unit is 30 lakh. Okay. 10AA deduction is available, but as I said, you do not allow this under the head PGBP, but from the total income you allow 10AA deduction. So this will come at a later point of time. Now profit from operation of cold chain facility before deduction under section 3580, 1 crore. Okay, this is 1 crore. And now you allow the deduction under section 3580. Because we are talking about regular provisions under the optional tax regime, 3580 can be allowed. So it is what? It is 100% of cost of building. Land is not eligible as deduction. So 100% of cost of building. Cost of building is what? It is 70 lakh. So 100% of this, that means 70 lakh will be allowed as a deduction. So balance is 30 lakh and the gross total income 30 plus 30 comes to 60 lakh. Okay, from this we allow deduction under section 80 JJAA because this is the only section which is mentioned here where the deduction is being allowed from gross total income. So we say deduction under 80 JJAA of 5 lakh rupees, and then total income before deduction under section 10AA is 55 lakh. 10AA deduction is allowable because we are talking about regular provisions under the optional tax regime. We are not talking about AMT at this point of time. So total income before deduction under section 10AA is 55 lakh. From this we allow deduction under section 10AA. Profits of unit into export turnover divided by total turnover. All these figures are given here in the question. So we simply apply these figures. We simply apply these figures and 100% of this amount is allowed. So this comes to 24 lakh and total income therefore comes to 31 lakh, and we compute tax on total income as per the rates applicable under the optional tax regime. Surcharge is not applicable because the total income is not more than 50 lakh, it is 31 lakh only, so no surcharge. We add 4% cess and this comes as the tax liability 772200 as per the regular provisions under the optional tax regime. So second amount of tax liability, regular provisions under the optional tax regime, 772200. Step 3 is now to compute tax liability under AMT, and we are under the optional tax regime. Okay, so first under the optional tax regime we made computation as per regular provisions, and now we make computation as per AMT. And why AMT? Because we know that deduction has been claimed under 10AA, 35AD, 80JJAA. There are other two conditions also. ATI should be more than 20 lakh, which we will now figure out and see whether that is being satisfied or not. So for that we will make computation of ATI, adjusted total income. So we will start with what? We will start with the level of total income. Total income not under default tax regime, under optional tax regime, because AMT is applicable when optional tax regime is applicable. So total income was 31 lakh. So total income 31 lakh. We start with this and then we add back what? 10AA, 35AD and 80JJAA. We add back. But as we noted earlier also, if we are adding back 35AD, in lieu of 35AD, we should allow depreciation otherwise allowable under section 32. On building, not on land. It is not allowable on land at the rate of 10%. So building was 70 lakhs, so 10% means 7 lakh. So we reduce depreciation at 7 lakh. So total income add 10AA, add 35AD, less depreciation, add 80JJAA, and this comes to 1 crore 23 lakh. And now we answer the question, is AMT applicable? So deduction is claimed under section 10AA, 80JJAA and 35AD. First condition is met. Second condition, ATI is more than 20 lakh. Okay. And third condition, so we are comparing, so within bracket we write if Mr. J is not covered under the default tax regime. Okay, if Mr. J was not covered under the default tax regime, then this third condition will also be satisfied and consequently AMT applies. And then we need to do what? We need to make computation of AMT. And it will be what? It will be AMT at the rate of 18.5% of ATI. ATI is what? 1 crore 23 lakh. 18.5% will be 22,75500, and then we add surcharge. For surcharge, we look at the amount of total income. It's 1 crore 23 lakh. Since it is more than 1 crore and up to 2 crore, the rate of surcharge will be what? It will be 15%. So 15% of this will be 341,325. And then we add cess at 4%, and this is what we get as the AMT, 2721,498. Since it is not rounded off to rupees 10, we need to round it off to rupees 10, which comes to 2721,500. Now we have got 2721500 as AMT and 772200 as the regular tax liability as per regular provisions. And what we need to do now, we need to compare both. And is regular tax less than AMT? Of course, 772200 is less than 2721500. So AMT is the minimum which you need to pay. So AMT needs to be paid. So is regular tax less than AMT? Yes. Therefore, ATI is deemed to be the total income and AMT is payable instead of regular tax. That means 2721500. Now, since the AMT is obviously more than the regular tax, the difference will be the AMT credit which will be available to Mr. J, which can be carried forward for being set off in a later year. So AMT credit available will be what? AMT 2721500 minus regular tax, which is what? 772200. This will be equal to 1949300 and this can be carried forward to the next year. Note the presentation, note the wordings and be careful of a good presentation, and the wordings that you write, the terminology you should use should be proper and accurate. It should not be vague and confusing. So you should carefully look at this example illustrations, how this should be solved, and this is the way you should solve, and there is no reason then why you should lose out on any marks. So now we come to the conclusion, and basically if you see, under the default tax regime, first we made computation under default tax regime and the result was 3875040. 3875040. And when we made computation under optional tax regime, we figured out that tax has to be paid as per AMT, which will be 2721500. So this AMT is more than the regular tax under optional tax regime. That's why AMT is payable. But AMT is less than the tax under default tax regime. So what should be the answer? Is default tax regime better or is the optional tax regime better? The optional tax regime is better because under the optional tax regime, AMT will apply and AMT will be 2721500, but it will be much lesser than the default tax regime tax liability of 3875040. So the assessee, Mr. J, should move out or opt out of the default tax regime. Since tax, so what will you write? It will be good to write a short note in support of your answer. Since tax liability under the default tax regime is more than the AMT liability, what should Mr. J do? Mr. J should opt out of the default tax regime. So he will need to pay AMT of 2721500 and carry forward the AMT credit of 1949300 for being set off in the subsequent years as per the provisions. But you also need to mention, as I told you some time back, that the assessee, Mr. J, has business income. PGBP is there, and therefore the opting out of default tax regime has its restrictions and limitations. So you should also write, however, he should note that the option to opt out once exercised can be withdrawn only once for a previous year, after which he will never be able to exercise the option except when he ceases to have income from business or profession. In that case, the restriction would not apply, but otherwise the restriction will apply. So Mr. J should be conscious of this restriction. If he is okay, it will be good to move out of the default tax regime. If he is not good with this restriction, then he can remain in the default tax regime and pay the higher amount of tax of 3875040. So this is how you need to solve basically these kind of questions. Okay, when the question asks you to compute the total income and tax liability in the manner most beneficial to the assessee, or the question simply asks you that just compute the tax liability, then you need to figure out all the angles. You need to make computation under the default tax regime and under the optional tax regime. Under the optional tax regime, you also need to make the AMT related computation if you find that AMT provisions apply. So in the question, if you see implications of 10AA, 35AD, or 80JJAA, 80QQB, or 80RRB, you should immediately consider AMT and then compute ATI. If ATI is not more than 20 lakh, the story of AMT gets over, AMT doesn't become applicable. But if ATI is more than 20 lakh, then assuming that the assessee will not opt for default tax regime under section 115 BSE, you proceed to compute AMT, and then you determine the tax under the optional tax regime. So tax under the default tax regime, tax under the optional tax regime, compare both and then arrive at your answer. If there is PGBP income, business or professional income in the question, then you also mention a note regarding the restrictive condition of opting out of the default tax regime. Okay, if the default tax regime tax liability is lower than the optional tax regime, then there is no question of opting out. You can simply write that the tax liability should be paid under the default tax regime as it is more beneficial to the assessee. If the optional tax regime tax liability is lower than the default tax regime, then you should write that the assessee should pay tax under the optional tax regime because the tax liability therein is lesser than that under the default tax regime. But since there is business income, in the case of the assessee should also be conscious or make note of the restrictive condition of opting out of the default tax regime. So this is how you should solve these kind of questions. Hope things are clear to you, the concept is clear to you. It's very important that you properly read the question as to what is being asked, and then you apply the right set of provisions. You should have solid conceptual clarity on all these provisions. You carefully note this example, the way, the method, the presentation, the steps, right? And you should practice it in writing. If you look at the practice book, there are several questions around this particular aspect where you are supposed to make computation at all these angles. So go through the practice book, solve all these questions. If you have any doubts, if you need any help from me, just write in the comment box or reach out to me on my WhatsApp number directly. I'm sure that you would have fully understood this concept. All my wishes to you, my best wishes to you. Good luck, and I'll see you very soon in my next video. See you soon. Bye-bye.